Welcome to the deep dive.
Yeah.
Today, we are going deep, really deep beneath the headlines.
Way beneath.
We're not talking about the latest flashy apps or, consumer gadgets. We're doing a full-scale analysis of the hidden battlegrounds.
The physical battleground.
Exactly. The supply chains, the infrastructure, and the brutal hardware economics that are really driving this tech boom in AI, in the cloud, and in EVs.
That's absolutely right. I mean, while most of the media is focused on software innovation, the algorithms, the models, our analysis shows the real strategic leverage comes from owning the physical foundation.
The actual stuff.
The actual stuff.
Right.
We're talking specialized silicon in data centers all the way down to the critical materials mined from the earth. That's where the power structure for the next generation is being built.
Okay, let's unpack this. We've got sources covering the big cloud titans, AWS, Azure, Google, Alibaba, and this incredibly expensive AI hardware war they're all waging. Then we're going to pivot to the struggle for crucial industrial materials. Rare earths, for instance. It ties this whole digital revolution right back to geopolitics.
Yeah, you can't escape it.
Our mission today is to show you exactly how these massive corporate profits are being reshaped and sometimes sacrificed for this investment in core infrastructure.
Let's do it.
All right, let's start with the cloud hierarchy. This is the arena, right? This is where the AI wars are being fought.
It is.
So based on data from November 2025, Amazon Web Services, AWS, still dominates the overall market. They've got a solid 31% share.
Which is still a huge lead. But here's the key detail.
Go on.
If you look just at infrastructure as a service, IaaS AWS pulls in a massive 50% of the revenue there, half the market.
And that IaaS distinction is so important for you to understand. IaaS is where companies rent the fundamental building blocks.
The servers, the storage, the networking.
All the stuff you need to run your business, and more importantly, to train your AI models.
So that 50% dominance in that one layer, that gives them this incredible strategic stability, even with all these competitors rushing in.
And that rush is being led by Microsoft Azure. They're the clear, but still distant second place at 20%.
Yeah, and their growth was just incredibly fast.
Well, it wasn't just about technical merit, right?
Yeah.
They were so smart about leveraging their existing Windows software, all their enterprise contracts.
It made Azure the easy, familiar choice for their huge corporate customer base, a very smart play.
Trailing them, you've got Google Cloud, GCP, and Alibaba Cloud, basically tied for third and fourth. They're each sitting at about 6% of the market.
And that landscape, that hierarchy, it dictates everything about this AI arms race. Because training these frontier models, it just requires unbelievable scale.
And scale requires incredibly specialized hardware.
Which brings us to the NVIDIA tax.
The NVIDIA tax. This is what so much of the hardware war is defined by right now. Most AI labs, most cloud providers outside of Google, they all rely on NVIDIA GPUs.
And they are paying a massive premium. I mean, look, a high-end GPU might cost NVIDIA, what, $3,000 to $5,000 to manufacture?
Something like that. And the buyer, the cloud company or the AI lab, is paying $20,000, maybe $35,000 per unit, sometimes way more in lease agreements.
That tax is so big, it basically dictates whether a company is even viable. The latest estimate suggests that for a company like OpenAI, their compute costs, it's something like 55 to 60% of their total $9 billion operating expense for 2024, just on hardware.
Wait, hold on. Over half of all their operating costs are just going straight into compute hardware.
That's what the numbers suggest.
Is that even sustainable? For long-term profitable growth? Or does that hint at some kind of bubble where the infrastructure costs just completely overwhelm the value being created?
It's the critical question, and it's exactly why Google has such a powerful secret weapon.
Their TPUs.
Their custom tensor processing units, yeah. By vertically integrating their whole stack, the chip design, the compiler, the training framework, they avoid the bulk of that NVIDIA premium.
A process that took them, what, a decade?
About a decade, yes. And that tight integration translates directly to a 4 to 6 times cost efficiency advantage at the hardware level.
A 4x to 6x advantage. And you can see that directly in the pricing for consumers, which is the ultimate weapon here.
Absolutely.
If you look at API pricing, Google's Gemini 2.5 Pro costs about $10 per million output tokens. A comparable model from a rival.
It could be $40, 4 times as much.
So Google is just crushing the intelligence per dollar war.
Yeah.
All because they own the silicon.
And this cost efficiency is forcing major shifts in the industry. It's causing this massive defection from the traditional hardware ecosystem.
You're talking about Meta.
I am. Meta has historically been a huge NVIDIA client. Now they're in talks to deploy Google's TPUs in their data centers.
Potentially starting in 2027?
It's a pivot valued in the billions, and it's a huge signal of how effective this vertical integration strategy really is. It's forcing Amazon and Microsoft to pour billions more into their own in-house hardware just to try and keep up.
The second Google or NVIDIA gets, say, a 20% efficiency lead, the models have to be retrained, updated. It fuels this whole hardware arms race.
And the intelligence frontier itself is moving so fast. OpenAI's GPT-5 just regained the lead on the Artificial Analysis Intelligence Index, scored a 68.
And for context for you, that 68 score means GPT-5 is now the state-of-the-art benchmark for things like multimodal reasoning, complex coding.
And it's fiercely contested. You've got models from XAI, Anthropic, and Google right behind it. But the point is, the speed of model innovation demands this race for cheaper, custom silicon. If you can't control the costs, you can't afford to innovate this quickly.
Okay, here's where it gets really interesting. Let's look at one player making enormous waves, specifically because of this pivot to AI infrastructure. Let's talk about Alibaba.
Their recent quarterly results were stunning. Just stunning. It showed exactly the kind of strategic clarity that wins in this environment.
Their Hong Kong listed shares surged more than 19% in a single day.
Their sharpest gain in 3 years. And it was all because of their commitment to the cloud.
The growth engine has completely shifted. The numbers prove it. Their cloud intelligence group, CIG, saw revenue jump 26% year over year.
And even more telling, their AI-related revenue. It's maintained triple-digit year-over-year growth for 8 straight quarters. 8.
They also just unveiled their new flagship model, the Qwen 3 Max.
Right, but what's so fascinating is the trade-off they're making. Alibaba is aggressively prioritizing long-term growth, pouring money into AI infrastructure, which is highly capital-intensive.
Even if it hurts their short-term cloud profits.
Exactly. They know that if they don't have competitive compute, they can't have competitive AI. And if they don't have competitive AI, they lose the future. Simple as that.
And you can see them paying the price elsewhere. Their core e-commerce division, it's still growing at 10% year over year, which is solid. But its adjusted earnings dropped by 21%. And that drop is attributed directly to heavy investment in instant commerce.
So they are actively feeding the future infrastructure beast by cutting into their current cash cow, sacrificing high-margin e-commerce for the AI and cloud future.
And this strategic clarity, it's having an impact beyond just their own balance sheet.
A big impact. Alibaba's performance helped lift the entire MSCI Emerging Markets Index. It's a signal to global investors that resilience in emerging markets means doubling down on future compute and vertical AI integration.
Okay, now we have to connect this massive demand in the digital cloud world, back down to the literal physical materials needed for all this new infrastructure.
Back down to earth.
Right, we're looking at sustained, aggressive growth in foundational components. The semiconductor industry is projected to hit $1 trillion in annual revenue by 2030.
$1 trillion. That's a 7.7% compound annual growth rate. And within that huge market, the sources point to a surprising leader.
The auto sector.
The automotive sector, yeah. It's actually the fastest growing market for semiconductors. It's projected at a 10% CAGR through 2030.
And that's driven by EDs and by what they're calling software-defined vehicles, or SDVs.
For anyone listening, an SDV is just a vehicle where software controls almost everything. Propulsion, infotainment, safety systems.
It's a data center on wheels.
That's the perfect way to put it. And because of that, the value of the semiconductor content inside a single car is projected to nearly double from about $800 in 2023 to over $13,350 by 2030.
And this brings us to a massive supply chain vulnerability, a choke point.
The choke point that underpins the entire green revolution. Rare earth elements, or REs.
You can't substitute them for high-tech manufacturing. Things like neodymium and dysprosium are critical for EV traction motors for advanced sensors.
A single high-performance EV can use up to 5 kilograms of this stuff.
And the global dominance fact here is just staggering. It creates so much geopolitical friction.
It really does. China controls 70% of the global mining.
And 85% of the refining and processing.
And 90% of the finished permanent magnet manufacturing.
But for the heavy REs, the ones you need for the most powerful motors, like dysprosium and terbium, that dominance rises to an almost total monopoly, 99%.
A 99% monopoly. That level of concentration means any hiccup, political or logistical, causes systemic vulnerability across the entire U.S. and European auto industries.
So how long would it take to build up non-Chinese capacity?
A long time. You're looking at 5 to 7 years minimum. And that's just for processing capacity.
Why so long? It's not just about digging ore out of the ground.
Oh, no. REE processing is incredibly complex, it's energy intensive, and it generates highly toxic waste. So finding places that can navigate environmental regulations, secure the capital, build the expertise, you're really looking at a 10 to 15-year sustained investment challenge.
It sounds almost insurmountable in the short term. And we saw a real-world example of this friction just recently.
In mid-2025.
Yeah, European auto plants had these unexpected production disruptions. It was because of delayed magnets. They had to use emergency air freight.
Incredibly expensive emergency air freight just to keep their EV lines running. That is the real cost of supply chain dependence.
And this scarcity, this risk, it's playing directly into corporate strategy.
For the legacy automakers, absolutely. The research we reviewed suggests many of them are actively lobbying against aggressive U.S. EV adoption plans.
Why? Because they want a slower transition.
They want to protect their profitable gasoline and hybrid car businesses. They see the supply chain risk and the capital costs of the EV transition as just too steep. It's institutional resistance.
So while they're resisting, you have these newer, focused players like Rivian trying to scale up production right in the middle of all this physical supply friction.
Exactly. The battle for profits is being fought over the availability of neodymium magnets.
So what does this all mean for you, the listener?
I think the future is being defined by two interlocking battles. First, you have the cost efficiency war in AI hardware. That's Google's vertically integrated TPUs versus the massive premiums of the NVIDIA GPU architecture.
A monopoly rent, basically.
You could call it that. And second, you have the geopolitical struggle for control over the physical foundations, from specialized semis to the near total dominance over rare earth elements.
It just shows that pure software innovation, it isn't enough anymore. Not to guarantee success or even viability.
Not at all.
Success now really depends on who can master the hardware supply chain and who is willing to pay the staggering cost of infrastructure independence.
And we saw that with Alibaba, right? Sacrificing short-term commerce margins to pour money into AI infrastructure because they see that physical foundation is the only viable growth engine for the next decade.
The race for custom hardware is intense, and it is driven by these huge cost barriers. We mentioned the threshold for a custom silicon design. It's often cited at $50 million in just non-recurring expenses.
And that's before you even get to maintaining the specialized software tools, which is its own massive challenge.
So we have to ask ourselves, and this is the question for you to consider, what happens to the future pace of innovation? And maybe more importantly, to the diversity of innovation, if that minimum investment to build competitive processing power becomes too high for everyone except for this handful of hyperscale giants?
That is the crucial question. What happens then?